Hello, everybody. My name's Max. Welcome back to the station. I appreciate you guys tuning in. I have a great video planned for you today. So Ulty has some competition on the way. Stick around to the end of the video and I'll tell you exactly how much this thing's going to pay. All right, I've been going through SEC filings. I wanted to give an early look at something that was interesting to me. The ticker is KYLD. Talked about this a couple months ago. At the time, they didn't have a ticker picked out yet, but I'm going to update it. We'll look at the prospectus, see if there's any changes and that kind of stuff. This is from Kurv, hence the K at the first of their name. They use K in a lot of their funds. KQQQ is one of their better funds. In any event, Howard Chan is the founder of Kurv, and I've had him on the show a couple of times, and I know him. And I was joking around with him that this ETF, that he ought to use the ticker KLTY, because it's, in my opinion, his ETF is going to be Kurv's version of Ulty. And he's a nice guy and stuff. I don't think he was that amused. To be fair, though, Howard's trying to carve his own lane in life, and Kurv is a different business model than YieldMax, and he's doing his own thing. He probably didn't appreciate my smart-ass comment. Anyway, I will go on the record as saying this. KYLD is a good ticker. KYLD, Kurv Yield, that's a good ticker. It's better than my ticker. That's why we let Howard make those decisions. I did pick the ticker for Salty, though. That's a true story. Go ask Jay Pestrcelli. What is Kurv's approach? Before we dig into KYLD specifically, let's talk about what makes Kurv different. Like I say, Howard's trying to do his own thing. Kurv has a different business model, different strategies than YieldMax. So Kurv focuses more on, of course, they focus on attracting monthly cash flow, but they focus more on the balanced approach. They more so than YieldMax, especially. They try not to have funds that go from $10 to $5 in the course of a year, but pay 100% or whatever. So they try to have more funds that go from maybe $10 to $11 and pay 20%. That's kind of more their business model. And we're going to take a look at some of those. And now this new ETF may not be like the other ones, but that's really all we have to look at is Kurv's past history. I've covered them quite a bit. It's an interesting company. And I've said this before. If you're a tasty trader, I think Kurv is the closest ETF to the Tom Sosnoff tasty trade kind of mechanics. I really think, based on my, talks with Howard, and Howard's never said that that he's a tasty trader. I'm not saying that Howard's doing it intentionally or copying or anything, but if you believe in that style of trading, I think Kurv's a good proxy for that style of trading. Okay, so now let's talk about the ETFs that Kurv's had out for like a couple of years. I think they have 5 or 6 of them, but we'll just look at them. In the left side, in the black corner, is Kurv. In the right side, in the blue, is in the blue car, I should say, or whatever, is Tesla. So is YieldMax. So in the first one, and let's look at the start price and the end price. TSLP, the Kurv product, went from 25 to 24, paid a $13 yield, which is pretty good. What is that, like 50%? 13's about 50% of 25, right? Maybe 55%, something like that. Anyway, pretty good. Now, Tesla, on the other hand, let's see what they did. They went from 23 to $9. However, they paid $19.59 in dividends over the time. Both of these funds use covered calls do covered calls on Tesla, or covered call spreads, some type of covered call. Well, anyway, but the difference is where Kurv differentiates himself is they use the monthly expiration cycle, whereas YieldMax uses the weekly expiration cycle. Weekly expiration cycle gets you more yield, but also impedes the NAV in a more severe way. And we can see that in all these results. So the Kurv one is NFLP. Look at this thing. It went from 25 to 36 since inception. I mean, infly is good too. It went from 17 to 16. It dropped exactly $1. And look at this. And it paid an infly from YieldMax paid a $16 dividend. Wow. I mean, on a $17 stock. So you're talking, 90%. NAV was down a little bit though, but I mean, it's pretty good. But it's just, this is indicative of kind of the curve, the way Kurv does stuff. They're going to make a fund that's going to go from 25 to 36. They're trading the same underlying. They're both using covered call spreads, whatever. That's not that big of a deal. But the monthly versus weekly is what differentiates Kurv. All right, so here's Goop from Kurv. This one's gone from 25 to 33 basically. Where GUI from YieldMax, good fund, gone from 18 to 13, but paid more yield. It's the same thing every time. The only time that doesn't hold true is on this one. MSFY is actually the Kurv product. MSFO is actually the YieldMax product. Since inception, MSFO, the YieldMax product, is beating MSFY, the Kurv product, on dividend and on total return, but still not on NAV return. NAV return is different than total return. The NAV return of MSFO from YieldMax went from 21 to 18. The NAV of MSFY went from 25 to 27, but the total return was still better with Kurv's method. Or I'm sorry, no, the total return was better with YieldMax's method. YieldMax won this whole competition on Microsoft. This is the one where the pattern doesn't hold true. All right, AMZP and AMZY, this one's pretty indicative of the normal relationship. The Kurv product has better total return, better NAV return, less dividends. All right, so let's talk about the strategy. So the strategy of this ETF, they're going to hold, this strategy of a covered call in general, they're either going to hold stock or hold synthetic stock. They're going to sell call options against the synthetic stock to generate premium income. They're going to distribute monthly income to shareholders. It's pretty familiar. We know how this works. And of course, when you sell call options, you accept a cap on upside in exchange for premium income. And call options, in a real oversimplified way of looking at it, selling call options on stock that you already own is similar to renting out a house that you already own. All right, so what do we know about KYLD specifically? This is still just a filing, and they haven't released a fund yet. Well, I can't wait, though. So the underlying focus is stocks with high IV. What does that sound like? That sounds like KLTY or like ULTY. That's why I initially made that comparison. So the stated goal is high, and the stated goal is high income. And in the prospectus, like the YieldMax prospectus says a primary goal of high income and a secondary goal of exposure to the upside of the asset or whatever. Well, this doesn't even say that. This just says straight high income. Okay, and this is directly from the prospectus. The advisor seeks a portfolio of listed securities and derivative instruments on such listed securities based on favorable outlooks. In other words, a stock they think is going to go up, examining characteristics of a particular issuer, such as growth, momentum, as well as the implied volatility of the derivative instruments listed on the listed securities. In other words, the option volatility. Implied volatility reflects the options or reflects the market's expectation of future price movements and is derived from the option prices. Higher implied volatility is indicator of potential for significant future price swings and higher potential option premiums. So they sell these high premium options to generate income. Now they charge a high expense ratio too, 1.16. It's roughly what YieldMax charges too. It depends on what fund. YieldMax has some at 99 basis points and some a little bit higher. Anyway, okay, so as far as when you get into the option strategy part, I didn't copy this word for word because it was kind of in the weeds, but they can do any trade they want. They listed all their trades, and we could talk about them, but I don't think you guys be that interested. Any trade that Ulty can do, they can do too. They're doing callers. They're doing, naked puts. They do put spreads. They do call spreads. You name it. They run the gamut. Something that I did notice in the prospectus that does set them apart from YieldMax is they can even do naked call selling. They can sell a naked call. You guys have heard of selling naked puts before, but you really probably haven't heard much about naked calls because it's a terrible idea. Do not do it. Yeah, in all seriousness, I don't sell naked calls for a variety of reasons. But in an ETF setting with professionals managing it, it could be a nice tactic. It's typically a technique for an investor to synthetically short a stock, kind of the opposite of selling a put. You sell a put, you're synthetically long the stock, or actually kind of synthetically long a covered call in the stock. Anyway, when you sell a call, you're actually synthetically long a covered put in the stock. So when you sell a call, or a call spread especially, you are synthetically doing the same trade that SLTY is doing. Synthetically. SLTY actually does it with actual stock, but you can also do it with options. All right, so who is this for? This type of strategy, it tends to appeal to income-focused investors. That's it. Don't do this if you don't need income. This is not a growth fund. And of course, it also helps if you believe the underlying assets, whatever's in the fund, and we'll cover it when it comes out. They're going to move stocks in and out. They're going to, because based on the volatility, I would imagine they'll have stocks in for a week or two here and then transfer them in and out. We'll see how that goes. But so if those stocks are appealing to you, do you think that those stocks might trade up or even sideways? Yeah, it might be good also. But it's also for investors who are willing to accept the capped upside in return for current income. Best for retirees, and in my opinion. All right, so here's the trade-offs, and I think I've already talked about these, but the capped upside. If the underlying asset rockets higher, you will capture all the gains. You guys are pretty familiar with that one as well. That's nothing special about Kurv. That's all covered call strategies. Full downside exposure. Once again, nothing special about Kurv. It's all covered call strategies. They're complex, they are, but that's why you guys watch this station, and there's other stations out there that do a great job also. But you have to study them. And also there's no track record. All I'm going off of is how Ulty's been doing. Here's my take. Here's the prediction. This thing's going to pay 40 to 50% and do a little bit better on NAV performance as compared to Ulty. And I know that just because of knowing Howard and studying the way he trades, and that could be vastly wrong. Maybe they'll pay 100% and do terrible on NAV. Maybe it'll just pay 20% and do great on NAV. I don't know. I'm going to say this is going to be a 40 to 50% payer. And it's going to be this. Who this is really for is somebody who thinks Ulty's too risky. Because in my opinion, just based on the other work that I've seen Howard do, he's going to build a less risky version of Ulty. KYLD represents Kurv's continued expansion of its yield premium strategy lineup. Whether it's right for your portfolio depends upon your income needs, your outlook on the asset, and a bunch of other things. I'll be watching this one closely. Like I say, well, as soon as it launches, we'll publish the first day's trades in there. We'll look at the positions. Maybe I'll even do a nightly. Maybe I'll even put it in the lightning spread report, especially if it looks promising. I mean, maybe it'll definitely go into the crypto quartet. The crypto quartet's now a quintet. All right. Now, I'm going to include in the comments or somewhere, I don't know if I'm going to publish this Patreon article. I might, but I'm going to include in the comments the link to this prospectus because I want you guys to go read it yourself. Maybe you'll see something I didn't see, or just plus because you need to be educated about what you're investing in. Those are kind of my initial thoughts on it. Well, what do you think? 40 to 50%. Better upside than Ulty. I mean, just compared, better NAV performance than Ulty. I mean, that's my guess. All right, guys. You guys going to be getting any of this for your account? I think I probably will. I'm really into the fund of funds and the ones that hold multiple stocks. I would imagine I get this pretty quick. I also have WPay. I also have Blocks. I also have Ulty. I also have GPTY. And I did have LFGY, but I sold it. But I love these types of ETFs. I think this is kind of the state of the art. All right, guys. Thank you very much. And I hope you have a wonderful afternoon.